Central banks are cutting interest rates again. Markets feel calm, forecasts look better, and more people are starting to believe the danger has passed. It's understandable. Lower rates feel like relief. They feel like confirmation that the worst has been avoided. But rate cuts don't usually mean the system is strong. They usually mean it's under pressure. The real warning signs rarely feel dramatic. They don't arrive with panic or headlines or obvious stress. They arrive quietly. They feel manageable, and that's why so many people miss what's actually building. Most people expect financial trouble to announce itself. They expect it to be loud. They expect it to feel uncomfortable straight away. But historically, it almost never does. The early phase feels stable. Rates come down, liquidity improves, markets behave, life carries on more or less as normal. And that calm creates an assumption that things are under control. When interest rates are reduced, people instinctively relax. Borrowing feels easier. Pressure feels lighter. It feels like a solution. But in reality, rate cuts don't fix underlying problems. They don't remove debt. They don't restore balance. They simply buy time. And buying time only matters if something underneath still needs fixing. This is where the misunderstanding sets in. When rates are cut while markets still look fine, most people hear reassurance. What's actually happening is strain is being managed before it becomes visible. That distinction matters. Because historically, central banks tend to cut rates after damage is obvious, after job losses rise, after defaults increase, after markets react. This time, the cuts are arriving while things still look orderly. That tells you pressure is being absorbed quietly rather than released openly. And quiet pressure is much harder to recognize. It's also easier to ignore because it becomes normalized. Higher debt doesn't feel dangerous when it builds slowly. Borrowing to maintain living standards doesn't feel like a crisis. It feels like adaptation. Refinancing at lower rates feels sensible, even responsible. But when an entire system depends on refinancing rather than reducing debt, stability becomes conditional. It only works as long as rates stay low, as long as growth holds, as long as confidence remains intact. That's not resilience, that's balance. And balance can tip without much warning. This is where scale starts to matter. When a system is carrying close to $40 trillion in federal debt, even small changes in interest rates have enormous consequences. Policy decisions at that point are about keeping things manageable, not about declaring victory. And you can see that disconnect very clearly right now. As I'm recording this, just before markets reopen, gold is trading around $4,342 an ounce. Silver is elevated as well, around $67 an ounce. And yet, there's no panic, no emergency headlines, no sense that anything unusual is happening. Most people barely notice. That contrast tells you more than the price itself ever could. Because when something genuinely dangerous is obvious, markets react quickly. When it's subtle, it gets absorbed quietly, often for far longer than people expect. Improving forecasts add to that sense of comfort. If growth projections look better, people assume the risk has passed. If inflation eases, people assume policy has worked. And if markets are calm, people assume the system is healthy. But improved forecasts don't mean structural problems have been solved. They mean conditions have been made easier. Easier conditions can delay outcomes without preventing them. That's why the focus isn't on a recession next month or even next year. It's on where pressure accumulates over time. Debt cycles don't break when things are uncomfortable. They break when things feel manageable, right up until they aren't. And that's why attention keeps drifting towards 2026. Not because it's a fixed prediction, but because refinancing cycles, fiscal strain, and policy limits begin to converge there. When rates are cut early, flexibility is used early. When liquidity is injected early, future options narrow. By the time stress becomes visible, most of the tools have already been used. That's the quiet part people miss. Psychology plays a bigger role here than most people realize. When markets are volatile, people stay alert. When markets are calm, people disengage. They stop questioning assumptions. They stop thinking defensively. They stop preparing. And at this time of year, that effect is even stronger. Christmas reinforces normality. It encourages short-term thinking. That's not a criticism, it's human. But it also sharpens the contrast between how things feel and how they're actually positioned. Some people notice that contrast. They don't panic, they don't rush, they just think a little longer term. You see it in small, almost symbolic choices. Some people buy things that last a season. Others quietly give something tangible. Sometimes a small piece of gold or silver, not as an investment pitch, not as advice, just as something that doesn't depend on forecasts or policy decisions. It's not about returns, it's about permanence. Those choices do not make headlines. They do not move markets, but they reveal mindset. They show who's thinking beyond the next quarter. And that's really what this conversation is about. Not fear, not predictions, not calling for collapse. It's about recognizing that the most important shifts rarely arrive loudly. Rate cuts feel reassuring. Calm markets feel safe. Positive forecasts feel convincing. But those things can exist at the same time as growing structural strain. When warning signs don't feel like warnings, people assume there aren't any. And by the time they do feel obvious, the choices are narrower, the adjustments are harsher, and the outcomes feel sudden, even though they've been building quietly for years. So as we move towards 2026, the key isn't panic, it's awareness. Don't confuse calm with safety. Don't confuse easier conditions with solved problems. And don't assume that because things feel normal, the system is healthy. The most important warnings don't announce themselves. They arrive quietly, they feel manageable, and they only make sense in hindsight. Thank you for watching. If you like this video, please give it a thumbs up. Of course, I would ask you kindly to subscribe to the channel and press the notification bell sign so you are notified of future videos. Thank you again, and we'll see you at the next video.